Stock trader laughed at black man's portfolio market opened, and his single position beat the entire firm. The laughter started before he finished the sentence. Not a chuckle, not the polite, suppressed amusement of people trying to be professional. Real laughter, the kind that comes out of a person before they can decide whether it is appropriate, which usually means it is not. It spread from one end of the glass-walled conference room to the other, the way fire spreads along a surface that has been waiting for a source. Three men in their 30s. A woman near the window who tried to convert hers into a cough and failed. A junior analyst closest to the door who looked at his shoes and said nothing, and whose silence will matter later. The man who had not yet finished his sentence waited. He had said, "My entire position is in one stock," and then the laughter had started. And he had waited for it to end, the way you wait for weather, not with impatience, not with anger, but with the steady patience of someone who has learned that weather passes, and what you said before, the weather is still true after it. When the room had finished, he said, "I'm sorry. Would you like to hear which stock?" Nobody answered, because the question had the specific quality of a question that resets the terms of a conversation, and rooms do not always recover from being reset quickly. His name is Darnell Okafor. He is 46 years old. He manages his own capital. He had come to the offices of Crestline Capital Management on the 31st floor of a building on West 54th Street because Crestline had sent him a prospecting letter, which was their error, and because he had decided to take the meeting, which was his calculation. By 9:47 the next morning, when the pre-market data settled and the opening bell released what had been building for 6 weeks in the structure of a position that nobody in that conference room had the framework to see, Darnell Okafor's single position would have returned more in 14 hours of trading than Crestline Capital Management's entire actively managed fund had returned in the previous 11 months. Nobody in that room knew what that quiet man was about to show them. Nobody knew he had been building this position for 2 years. They were about to find out. They always find out. Subscribe and tell me where you are watching from. Now come back with me, not to the 31st floor, down, back to the beginning, back to where the position was built long before a prospecting letter arrived in the wrong mailbox, and a room full of people decided to laugh. Darnell Okafor grew up in Gary, Indiana, in a household where money was discussed. The way serious things are discussed, not avoided, not mythologized, but examined, named, accounted for. His father, a man named Curtis Okafor, had worked the same shift at a logistics facility on the south side of Gary for 22 years. He was not a financial professional. He had not attended college. What he had was a yellow legal pad that he kept in the kitchen drawer, under the takeout menus, that he updated every Sunday evening at the kitchen table with the specific, unhurried concentration of a man performing a religious observance. Income in the left column, expenses in the right. The difference at the bottom, which some weeks was very small and some months was nothing, and which Curtis tracked across years with a consistency that was, in its quiet way, a form of discipline that no one who saw the yellow legal pad from the outside would have fully understood. Darnell sat at that table on Sunday evenings. Not because Curtis required it, because he was drawn to it, to the act of accounting, to the idea that a number written down was different from a number only held in the mind, more real, more honest, more accountable to itself. He was 8 years old when he first sat beside his father and asked what the columns meant. Curtis explained them without condescension, the way practical people explain practical things. This is what comes in, this is what goes out, this is what remains, Darnell said. What happens to what remains? Curtis said. That's the right question. He did not have a full answer. Not then. He had a savings account that he funded with the remainder and that earned the interest rates of the mid-1980s, which were better than today but which still represented, as Darnell would understand years later, a form of participation that was available but not optimal. Curtis knew this intuitively. He used the word investment sometimes, in the way people use words they have heard but not yet had access to, as aspiration, as a direction, rather than a destination. Darnell went looking for the destination. He found the library. This is not a metaphor. The Gary Public Library on West Fifth Avenue had a reference section with periodicals that included back issues of financial publications and an economics section that a librarian named Mrs. Paulette Hines kept organized with the same care that Curtis kept his legal pad. Mrs. Hines noticed Darnell when he was 11, when he had worked his way to the investment section from the general economics shelves and had checked out the same book on market fundamentals twice in 3 weeks. She did not ask him questions. She put things on the table beside him. A different book, a magazine with an article marked, a pamphlet about a summer program at a university extension that taught basic financial literacy to high school students. She put things in reach and let him decide what to pick up, because she understood that the most important engine of a young person's learning is the agency they feel in directing it. Darnell picked everything up. He attended the financial literacy program the summer between his sophomore and junior year of high school. He was the youngest participant by 2 years, and the only one who had not been referred by a guidance counselor. He had found the pamphlet himself, on the table where Mrs. Hines had set it. The program was basic. It was not Wall Street. It was budgeting, compound interest, the difference between an asset and a liability. For most participants, it was new information. For Darnell, it was the formal language for things he had already been observing at the kitchen table on Sunday evenings. He sat in those sessions and felt, for the first time, that the thing he had been circling had a name. Not money. Capital. The distinction mattered. Money was what you earned. Capital was what you built. The building was different from the earning. The building required a different kind of attention, a longer horizon, the willingness to think in years rather than weeks. He was 16 years old, and he understood compound interest not as a formula, but as a fact about time. Time was the variable that most people underestimated. Time was the thing that the yellow legal pad accumulated, year by year, in the column labeled remainder. He went to a state university on a partial scholarship and worked 2 jobs to cover the rest. He studied economics. His professors were good. They taught what they knew, and what they knew was useful. What they did not teach, what no classroom teaches, because it cannot be taught in a classroom, was the specific texture of markets in motion, the way a sector behaves when a macroeconomic condition changes, the way a single company's fundamentals can diverge from its price for months before the divergence resolves. The gap between what a thing is worth and what the market currently believes it is worth, and the patience required to hold a position across that gap. He learned this the way it can only be learned, by doing it with real money, starting with very little of it and paying close attention to every mistake. He graduated and took a job in the back office of a regional brokerage in Chicago, not as a trader, not as an analyst, as an operations associate, the unglamorous infrastructure of a financial firm. He was there for 3 years. He processed trades, reconciled accounts, managed the paper trail of other people's financial decisions. He watched from the back what happened at the front. He watched what the traders did, how they thought, how they framed their theses, what they got right repeatedly, and what they got wrong repeatedly. He noticed that what they got wrong repeatedly shared a structural quality. They were optimizing for a short horizon. Not because they were incapable of longer thinking, some of them were very smart people, but because the incentive structure of the firm optimized for the short horizon, and they were human beings inside an incentive structure, which is what human beings always are. Quarterly performance, annual bonuses, the pressure to be right frequently rather than to be right consequentially. Darnell was interested in being right consequentially. He left the brokerage after 3 years. He had saved the remainder column every Sunday evening, the practice his father had built into him, and he began managing his own capital, not large capital, the capital of a 26-year-old who had spent 3 years in the back office of a brokerage making a salary that was not large. But it was his, and the decisions were his, and the time horizon was his to set. He set it long. He developed, over the following 18 years, a framework for analysis that was his own, in the specific sense that it had been built by him from the ground up, from the reading and the back office observation, and the mistakes and the corrections and the refinements that 18 years of doing a thing while paying close attention produces. He did not have a name for the framework. He did not need one. It was a way of looking at the relationship between a company's fundamental value and its market price over time, identifying the conditions under which that relationship was likely to resolve in a particular direction, and having the patience to hold a position until the resolution occurred. He had a notebook, not the yellow legal pad that was his father's. His own was a graph-ruled composition book, black cover, the kind you buy at an office supply store for $3.40. In it, he recorded every position he had ever held: the thesis, the entry price, the hold period, the exit price, the outcome, and this was the practice that distinguished it from an ordinary trade log. The reason the thesis had been right or wrong, written out in full sentences, as a post-mortem discipline. Not what happened. Why? By the time the prospecting letter arrived from Crestline Capital Management, Darnell had filled 11 of those notebooks. The letter had been sent to him in error. His was one of approximately 300 names acquired from a wealth management referral list that Crestline had purchased. The referral list was built on income and asset indicators that met a minimum threshold. Darnell met the threshold. The letter addressed him as a high-net-worth individual and invited him to a consultation about whether Crestline's actively managed funds might complement his existing investment strategy. He had no reason to take the meeting. He was not looking for outside management. He had not underperformed. He did not need Crestline. He took the meeting because he was curious about what they would say, and because he had learned 18 years ago in the back office of the Chicago brokerage that watching how professional financial people thought and communicated was its own form of education, and because on some level, which he would not name in that conference room but which was there, he had a single position that he had held for 26 months, and that was reaching the point in its thesis where the resolution was approaching. And he was interested, in the specific way of a man who is very confident in something, in hearing what a room full of professional financial analysts would say about it. He brought the notebook, the graph-ruled composition book, 11th volume. He set it on the conference table. He said, "My entire position is in one stock," and the room laughed. The company was called Veritas Industrial Systems. It was not a name that anyone in that conference room would have recognized on sight. It was not a name that appeared in the financial press with any frequency. It was a mid-sized industrial manufacturer operating in a sector precision components for infrastructure maintenance equipment that institutional investors rarely covered because the sector was unglamorous and its growth trajectory was slow, and its quarterly numbers were not the kind that generated the enthusiasm required to attract analytical attention. This was, in Darnell's framework, the condition of maximum interest. He had found Veritas 26 months ago through a process that was not intuition and was not luck, though it would later be described as both by people who were more comfortable with those explanations than with the alternative, which was that he had done the work. He had been reading infrastructure legislation, the actual legislative text, not the summaries, not the analyst notes about the summaries. And he had identified a specific appropriations provision that directed federal spending toward a category of infrastructure maintenance that Veritas's product line served almost exclusively among domestic manufacturers. The provision was buried in a 412-page bill. It was not the kind of thing that generated press coverage. It was the kind of thing you found when you read 412-page bills. He had then spent 6 weeks examining Veritas's financials, not the headline numbers, the footnotes, the inventory turns, the customer concentration data, the contractual backlog that was disclosed, partially, in the MD&A section of the annual report in language that most readers skipped because it was dry and required context to interpret. The context was the legislative provision. With the context, the backlog numbers said something specific. Veritas had already begun receiving orders against a spending category that had not yet been publicly activated, which meant the market had not yet priced the information that the financials, carefully read, made visible. He had entered the position at $11.40 per share. At the time of the Crestline meeting, 26 months later, the stock was trading at $22.15, a position that had approximately doubled. He had not sold. He had not sold because the thesis was not complete. The federal spending had been appropriated but not yet disbursed. The disbursement would trigger revenue recognition that would appear in Veritas's earnings report. The earnings report was 6 weeks away. When the numbers landed, the market would reprice the stock based on information that had been available to anyone willing to read a 412-page bill and 6 weeks of footnotes for 2.5 years. He knew this. He had known it for 6 weeks. He had written it in the 11th notebook in the specific, full-sentence post-mortem language he used for every position, not as a prediction but as a thesis statement. The resolution of this position will occur when the earnings report reflects the disbursement-linked revenue. Estimated timing. Q2 report. Week of the Crestline meeting plus 6 to 8 weeks. He was inside the window. He had come to the Crestline meeting, in part, to see whether anyone in that room, professionals who managed other people's capital for a living, who had analytical resources and research budgets, and teams of people whose job was to find exactly the kind of discrepancy he had found, had seen Veritas. They had not. He could tell within the first 4 minutes of the meeting, before the laughter, from the way they looked at his notebook and the way they asked their questions, which were the questions of people who had no frame of reference for what he was sitting on. He said, "My entire position is in one stock." The laughter started. He waited. He said, "I'm sorry. Would you like to hear which stock?" The junior analyst near the door. A young man named Tobias, 24 years old, 11 months out of his MBA program, who had been in the room because his managing director had brought him along as a learning exercise, looked up from his shoes. Tobias said, "Yes." It was not a bold intervention. It was not heroic. It was a 24-year-old choosing, in a small way, between the behavior his colleagues were modeling and the behavior he thought was appropriate. It was the kind of choice that is easy to underestimate and that turns out to matter more than the larger choices that come later, because the small choice is the one that establishes what a person will do when the room is not watching for it. The managing director looked at Tobias. Then he looked at Darnell. The laughter was gone. "The room had the specific quality of a room that has been reset," Darnell said. "Veritas Industrial Systems." Silence. Then the managing director said slowly, "I don't think I know that name." Darnell said, "I know." He opened the notebook. He took 41 minutes. He walked through the legislative provision, the footnote analysis, the backlog interpretation, the timeline for the earnings disclosure. He spoke with the economy of a person who has explained something to himself so many times that the explanation has become clean, without excess, without the hedging language that people use when they are uncertain of their ground. Nobody laughed. The managing director made a note. The woman near the window made a note. The junior analyst Tobias filled an entire page of his legal pad. When Darnell finished, the room was quiet for a moment. The managing director said, "When is the earnings report?" Darnell said, 6 weeks. He closed the notebook. He picked it up. He stood. Approximately. He left the 31st floor of the building on West 54th Street and walked to the garage and drove home and made himself dinner and went to bed at 10:15 and slept without difficulty. The way people sleep when they have done the work and the work is done. The earnings report was released pre-market on a Tuesday morning, 6 weeks and 2 days after the Crestline meeting. Veritas Industrial Systems reported revenue of $47 million for the quarter, against analyst estimates from the handful of analysts who covered the stock of $31 million. The beat was 48%. The disbursement-linked revenue had appeared in the numbers exactly as the legislative provision and the backlog footnotes had indicated it would. This was not a surprise to Darnell Okafor. He had been watching the news release channel for Veritas for 6 weeks with the specific, patient attention of a man watching the resolution of something he already understands. At 9:30 a.m., when the market opened, Veritas Industrial Systems opened at $22.15 and began to move. By 10:15, it was at $31.40. By 11:02, it was at $38.80. By the time it settled at the close of the trading day, at $41.30, a gain of 86% from the previous close. On volume, that was 42 times the stock's average daily. Trading Darnell Okafor's position had produced a return that, measured in absolute dollars across the 26 months he had held it, represented a gain of approximately $890,000 on an initial investment of $342,000. In the offices of Crestline Capital Management on the 31st floor of the building on West 54th Street, the trading floor had been watching Veritas since pre-market. Not because they had acted on the meeting with Darnell 6 weeks earlier, they had not, or not in time. The compliance process for a new position of that kind required internal approval that had been in process and had not cleared before the earnings date. But because Tobias had flagged it, at 8:41 that morning, in the firm's internal chat system, with a note that said only, Veritas, remember the meeting, watch it today. The managing director watched it all day. He called Darnell at 4:17 in the afternoon. Darnell answered on the third ring. The managing director said, I want to acknowledge something. Darnell said, all right. The managing director said, the way that meeting began was not acceptable. I should have said that at the time and I did not. And I am saying it now. A pause. And the analysis was correct, which is, he stopped. Then, I don't have the right words for what that analysis was, Darnell said evenly. It was thorough. The managing director said, it was remarkable. Darnell said, it was thorough. Remarkable implies something I did that other people couldn't. I read what was available. That is available to anyone. He said that, and then let it rest there. He did not make the managing director comfortable with it, and he did not make him uncomfortable. He stated it because it was true, and because the truth of it was, in some ways, the most important thing he could leave the man with. The information had been available. The work had been available. The 412-page bill, the footnotes, the MD&A, the backlog numbers available to a firm with 16 analysts and a research budget and all the infrastructure of professional capital management. And a man with a graph-ruled composition book from an office supply store and 18 years of Sunday evenings had seen it first. The managing director said, would you be willing to consult with our research team? Darnell said, I'll think about it. He thought about it for 3 weeks. Then he called Tobias, not the managing director, Tobias, the junior analyst, who had looked up from his shoes and said yes. He called Tobias because the yes mattered. Because in a room that had chosen a particular behavior, one person had chosen differently, and Darnell believed, as a matter of practice and principle, that the choosing of differently should be rewarded whenever it was in his power to reward it. He had been building that belief for 18 years, since the back office of the Chicago brokerage, where he had watched how rooms shaped behavior and had decided that the shaping ran both directions. He said, I have a research project I would like your help on. It will take approximately 3 months. I can offer you a consulting fee, and I can offer you the kind of analytical experience you will not get at Crestline for at least 5 more years. I will not offer you what I am looking at specifically until I trust your discretion. That will take some time. Tobias said, when do we start? Darnell said, Monday. Bring your own notebook. The Veritas position closed 14 months after the earnings report. Darnell sold at $53.40 per share, as the fundamental thesis had fully resolved and the return had entered the territory where the forward expectation no longer justified the concentration risk. He noted the exit in the 11th notebook, in the post-mortem column on the right side of the page. Thesis confirmed on timeline. Resolution as modeled. No material deviation from original framework. Then he started the 12th notebook. In the first entry, dated the Monday after the Veritas close, he wrote the thesis for a new position. A company in a different sector, different geography, same basic principle. A gap between what something was worth and what the market currently believed it was worth, wide enough to hold a thesis, and the patience to wait for the resolution. He was not the only one working on it. Tobias, 13 months into the consulting arrangement, had developed the kind of analytical discipline that looks, from the outside, like talent, but is actually the product of being required, week after week, to write out your reasoning in full sentences and defend it against someone who has been doing this for 18 years and who does not accept the hedge, the approximation, or the conclusion that outpaces the evidence. Tobias had been required to rewrite his thesis statements 14 times in 13 months. Each rewrite was tighter than the last. Each one was closer to the thing itself. He had bought his own graph-ruled composition book, black cover, $3.40. He had written in the inside front cover, in the small handwriting he used for things he wanted to see often, "What remains is the right question. Build from what remains." His father did not know what the sentence meant in its current context. He would have recognized the practice beneath it. On a Sunday evening in November, Tobias sat at a table in his apartment in Brooklyn and opened the notebook and began to write. Not a trade log, a thesis statement. 7 paragraphs, full sentences, no hedging, the evidence in the order in which it compelled the conclusion. He sent it to Darnell at 11:17 p.m. Darnell read it at 6 the next morning, read it twice, made 2 marginal notes, one a question, one a correction. Then he wrote 3 words in a reply, "Now you're seeing." Tobias read it at 7:30, on the train. He read it 3 times. Then he opened the notebook to a new page and kept working. The remainder accumulated, year by year, page by page, passed from one set of hands to the next. The way it always has been, for anyone patient enough to understand that what you are building is longer than a quarter and wider than a conference room, and older than the laughter that tried to stop it before it started. The remainder is the right question. Build from what remains. The thing I cannot leave alone is the yellow legal pad, not Darnell's notebook. Curtis's, the one in the kitchen drawer, under the takeout menus. The one updated every Sunday evening with a precision and a consistency that nobody outside that kitchen ever asked about, that produced no public recognition, that was not an investment strategy by any formal definition, and was not intended to be. It was just a man, at a table, accounting for what was true about his life in numbers, because numbers do not lie to you the way more comfortable forms of self-assessment can. The right question came out of that table. It came out of an 8-year-old sitting beside his father and asking, "What happens to what remains?" Curtis did not have the full answer. He had the habit. The habit passed. The habit became a framework. The framework became 11 notebooks. The notebooks became a position that a room full of professionals did not see until a 46-year-old man with a graph-ruled composition book opened it on their conference table and took 41 minutes to example. Show them what reading carefully and thinking slowly and waiting patiently looks like when it has had 18 years to compound. What compounds is not only money, attention compounds, discipline compounds. The practice of writing the reason, not just the outcome, that compounds. What you learn from your mistakes when you have required yourself to account for them honestly compounds into something that a quarterly performance bonus cannot produce and a research budget cannot buy. And here is the question I need to ask you, the uncomfortable one, not the easy one. What are you doing with what remains? Not the big amounts, not the inheritance or the windfall or the year when everything goes right. The small remainder, the $37 at the end of the month. The 45 minutes on a Tuesday evening that did not get consumed. The attention that you have available when the noise goes quiet. Are you accounting for it? Are you writing it down? Are you treating it as capital, as something to build from, or as something that disappears between one week and the next without an account? One word in the comments. Not your portfolio. Not your net worth. The thing you have been letting disappear in the remainder column that, if you accounted for it properly, might turn out to be the position you have been sitting on for longer than you know. If you know someone who is doing the slow, unglamorous work of building something that a room has not yet had the framework to see, share this with them today. Not to tell them they are right. Just so they know the resolution comes. It always comes when the thesis is sound. Subscribe. Because I am not done finding people who did the work before the room was ready to watch it, and the world needs to know that those people exist, and that the work was real, and that the laughter was wrong. And next time I want to tell you about a 72-year-old Jamaican-American botanist who spent 31 years cataloging a species in the Florida wetlands that university departments said did not exist. And on the morning the peer review landed, 3 institutions called to apologize. Same story, different field notes, same patient, accurate hands doing the looking. I will see you there.